Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary.
Hello and welcome to LiveSquawk's Market Talk, our weekly review. This is where we try and break down the key stories of the week gone and implications for the markets. We'll also take a look at the week ahead and give you a heads up to what you should be looking out for. I say we because every week I'll be joined by a market expert in their field. And in this episode, I'm joined by Ryan Littlestone of Forex Analytics. Hello, Ryan. How are you doing?
Yeah, hello, Harry. All good, mate. How are you?
Awesome. Ryan, he's been around the markets for more years than he cares to mention. And if you want to give a little heads up as to Forex Analytics and what you do there.
Yeah, sure. Yeah, I'm a trader by nature and an analyst at Forex Analytics, where we have a big community of traders on our platform and a lot of analysis tools for traders. And big, massive community. And it's a good place to hang out and talk markets.
Awesome. Forex Analytics, we'll put the links up to where you can find Ryan after this episode. Right, now, we're recording this on Friday, the 5th of September at 3 o'clock in the afternoon, London time. For anyone who doesn't know, we've just had, or a couple of hours ago, we had non-farm payroll US jobs report out. So we'll take a look at that first and foremost. And just for anyone who may have missed it, we saw another shocker of a report. For the August number, we had 22,000 jobs of non-farm payroll jobs from expected 75,000 from a previous 73,000 that was revised. And we'll go into revisions in a minute. The unemployment rate came in at 4.3%. That was in line with forecasts from 4.2. And again, if you listened to us last month, that 4.2 was very nearly 4.3 anyway after rounding. Average hourly earnings came in at 0.3% from 0.3 expected, putting the year over year at 3.7%, a tenth shy of estimates and 0.2 shy of the initial read last month. US change in private payrolls came in at 38,000 from 75,000 expected after 83,000 was revised to 77,000. Manufacturing payrolls fell by 12,000. Government payrolls were down 16,000. And the 2-month net revision came in down 21,000 after a fall last time around of over 250,000. Again, shocker of a number there initially. And we'll get into the reads with that. Now, Ryan, do you got any views on what we saw today, and does it really change any of the narrative going into the Fed September rate decision?
Regarding the Fed, yes and no. It doesn't really change the 25 pip cut expected in September. That's a done deal. That would have been a done deal, I think, even if we got a higher number than we did today. It's difficult to really call it a shocker. In percent terms, the miss was quite hefty. 22 from 75 expected. 53,000. That's a big miss. It's not a big miss when you're talking in triple digits. If we were talking between 200 and 250, it's not such a big miss. So percentage wise, it does look bigger. I've been making a point pretty much all this week. It's the trend that's more important. We've seen the jobs market weakening probably for the last 2 years. Not a great shades, but it's slowly been coming down. We've had the odd upside out there, but it's been drifting lower. It's in line with what we've heard from the Fed heads that firms aren't hiring, but they're also not firing. So I think a shocker would be if it falls off a cliff. At the moment, it's doing this soft landing thing right now. And I think even if the US has 20K, 10K, 5K jobs for the next, 3, 4, 5 months, it will look weak, but it's still jobs growth. It's not firing. It's not people becoming unemployed. You mentioned the unemployment rate ticked up to 4.3% from a near 4.3%. So if you're counting those third decimals, it's unchanged. But then the participation rate ticked up by a point. So that adds to it as well. A shocker would have been 4.5% or something like that. But the market's going to do what the market's going to do. It can't get any more dovish about September except to start pricing 50 basis point cuts, which I think would be too much.
Well, I think there is a small pricing, I think 10%.
Yeah, something small.
Like
and I don't think that's going to last long. But again, as I've been saying through this week, it's not about what the Fed do at the September meeting in terms of rates. It's about those updated projections. Is this data, is next week's CPI data, which I know we're going to talk about, is that going to change the dot plot? Is that going to see the Fed bringing down rate expectations or the path of rates steeply for the rest of this year and going into next year? Because that's what we're trading. We're not trading what happens in 2 weeks. We're trading what happens in 3, 6, 8, 9 months time with rates. And I think that's where we're going to be seeing the shift. So we've seen a bit of a sell-off in the dollar. We've seen yields coming down. That's certainly not something I'm going to fade. I've already faded a bounce in the dollar today after those numbers. I think we're going to see the dollar grinding lower, as will yields.
Okay, so non-farm payroll really just following the trend and doesn't change that narrative in any significant way, as you've mentioned. Maybe just pushing Fed rate cut expectations further in, or further out rather, as we go along. So again, I've got a bit of a bank note here. This is from Bank of America. They say the August report should cement a shift in the Fed's thinking from worrying about inflation to focusing on labour weakness. I think they were already worrying more about labour weakness than inflation anyway, as we've discussed previously. They now expect the Fed to cut by 25 basis points each in September and December, and then another 75 basis points next year for a terminal rate of 3 to 3.25%. The bank says another cut in October is on the table, but isn't our base case. We think over 3% core PCE inflation will keep the Fed cautious. So even though it isn't their central worry, inflation will obviously still play a part in just reining in the doves on the committee. Right, turning to the other side of the pond, we had Eurozone inflation, which ticked higher, but we're not expecting any move from the ECB, which we do have ECB rate decision next week. We're not really expecting anything from that. Anything on the Eurozone inflation that worried you at all, either side, whether we could see an acceleration to this disinflation or...
No, nothing I've seen that suggests we're going to see sort of what's happened in the US, where we've seen, I think it's the last 4 months, inflation, ramping higher a bit. They're still around their 2% mark. There's no real reason for them to change policy unless inflation starts heading back under 2% and sort of accelerating to the downside, which is still really a possibility because, growth is anemic over there in various countries. You have the odd outliers like Spain, but the big ones, Germany, France, they're still not doing so well. And that tends to bring deflationary pressure naturally, because if firms aren't selling products, they're going to cut prices to try and gain that business. And then you see, as I say, an acceleration in the disinflation. So there's still risks more to the downside of inflation, in my opinion, than the upside. But with this tariff mess still going on, you can never rule out seeing some upside.
Sure. And I was looking at one of my other guests about when we start to see some of this tariff effect really start to play, and we should start seeing it from September, October numbers apparently. So compared to when we saw the introduction of tariffs or the announcement back in April to now, when we're actually the implementation and the tariffs actually in play. Obviously that could all get unwound if this court case goes against them, but we'll worry about that when it comes to it, because that's a whole episode on its own. Regarding the ECB then, I've got a note here from Citi that says ECB is likely to keep its policy rate unchanged at 2% next week in the middle of its estimated neutral range. The new start projections may result in slightly higher growth for 2025 due to first half 25 GDP and limited evidence of near-term slowdown. A higher euro and lower energy prices imply downside risks on inflation forecasts, but we expect only marginally lower 2026 HICP 2026 forecast and 2027 unchanged at 2%. Despite this being more hawkish than our earlier expectations, we still expect further rate cuts in the coming months and quarters to reach the lower end of the neutral range at 1.5%. So really, ECB, for many analysts think they've just hit pause for the time being rather than a full stop. That's a contentious point, but that's generally what I've read. The issue I think we've got, and we'll go on to this as well, because next we'll blend to the week that was with the week ahead, because we do have this French confidence vote, which we'll come on to in a minute. So we'll look at that. I just want to really stay with this week and the past sort of 5 to 6 days. Gilts. We've had bond moves and bond yields, and there's been a lot of again hyperbole around this, really, about the growth in long end yields. How much do you pay attention to what we've seen in yield moves of late for your as a primarily FX trader? Do you pay much attention to what you see there? Is it just something that helps frame your trading?
Yeah, in the longer end, it's more. I look at that from more of a fiscal perspective. For me, it's the market judging the fiscal situation in various countries. Obviously, the shorter you come down, the more it's interest rate led, central bank led. But we're seeing these moves, and global yields are moving a lot the same way. You look at yields today. We've seen down yields in tens, but the long end, like the 30s, they're all pretty much moving in the same direction at the same time. And I think that is all because of the same reason. A lot of talk, as you know, about UK yields going up, but we've seen the same in the US. But the US has got their fiscal issues going on as well. Trump's beautiful bill, how much is that going to cost? Putting pressure on finances. Talk about Japan as well. They've got a bit of political mess over there, and again, they're looking at doing more fiscal measures. And it's the same in Europe with all this spending money that they're magicking out of thin air now for defence spending and all that sort of thing, which is supposedly good for GDP, but it's also a ton more borrowing, especially Germany, borrowing more and more. So it is really a reflection of the fiscal picture, and there's not a lot of positive news around that at the moment. As I say, just fiscal spending is taking off, borrowing's taking off. And until that starts really slowing down, particularly when we're seeing economies, not going gangbusters in activity, it's going to present a problem for the markets.
I mean, this is a long-running issue of mine, is that I don't think we've ever really addressed 2008 and the borrowing that went on there and everything that happened then.
Yeah, absolutely. Yeah.
I think, as far back as that was, we haven't really addressed it. And again, it reared its head with COVID and everything else. No one's paying the piper, and we haven't paid the piper for a very long time now. And listen, I'm not an economist, so I can't say for sure, but I just know that ultimately you delay the inevitable, then it gets worse. And so at some point, this needs to be addressed, and we can talk about that with Rachel Reeves in the UK situation at the moment. It's not unique to the UK, but there is an issue there, isn't there, with the fact that successive governments, I'm not partisan at all on this, have really missed their opportunity to try and do what's right fiscally for economies. And it's not just the UK, as you said. The US has got its issues. Europe is a slightly different case, but you can see the case for it as well. Is it warranted, the criticism she's coming under at the moment? And do you think there is a particular problem with the UK over and above what we're seeing elsewhere?
Yes, I think there is a problem. For one, it's market confidence, that she really doesn't have a clue. But just going back to what we're talking about, yes, after the GFC and all that, we entered a real low rate period, and that was good for countries, to issue borrowing at really low rates. Then you get hit by the COVID and the inflation blip with the Ukraine stuff, and all of a sudden instead of borrowing at 0.2%, you're borrowing at 4 or 5%, and that becomes a big issue moving forward when you have to pay all that back. But in terms of the Chancellor, yeah, I mean, she's raising taxes, and she's having to raise taxes with an economy that isn't on its best footing. you can look at the retail sales of the last few months and say, yeah, they've been pretty good. But the sun's been out, so September's done nothing but rain. So I'm expecting retails to fall off a cliff when we get to that period of the data. But every which way she turns, she's got a problem, because it's okay raising taxes when your economy is doing well. If we're running at 2%, 3%, 4%, 5% growth, fine, you've got room to raise taxes. When you're walking along the zero line, 0.1s, 0.2s, 0.6s, you haven't got room to raise taxes on that income, because you're not earning it. It's like a business. You're not earning the income, so you can't tax to get more income out of squeezing blood from a stone. So, yeah, she has got a problem.
That depresses everything. It depresses sentiment as well as as activity, I guess.
Yeah, it does, because all you're doing is just keep squeezing people and squeezing more and more people. And I won't get into all the tax the billionaires and all that sort of stuff, because that's a different political slant to a market slant.
Sure.
But the market is going to look at this, and there's a possibility. And personally, I've been getting short on the pound via euro sterling for a bit, because I see these storm clouds. I've probably been the most bearish on the UK I've ever been at the moment. I'm never a perma bear. I know we can tend to rally against the narrative, the negative narrative that we're spun in the press. But I've never been so bearish on the UK. And I think you've
been doing this a long time. You've been doing this a long time, and for you to say that I'm a little bit worried about that. But like it highlights then some of your experience and your depth of knowledge in the market. Thinks this is the worst time we've seen for the UK. Yeah,
and I think it is, and I think Labour keep going back to the trust stuff. The issue started well before trust. The inflation jump started before trust even came in the door. There was the LDI issues as well. But this is why I say yields are higher now than when the trust incident happened. But it's been a steady move higher in these yields. So that's
which is why there's been less panic, because it wasn't a jump. It was
exactly. It's not a one-off panic move. This is a building move.
Yeah.
And I think it's going to come to a point. It's going to come to a head over this budget, because unless she pulls a rabbit out the hat, there's no way she can grow her fiscal headroom with any other thing other than raising taxes. And that's not going to go down well in an economy that's not growing significantly. And I think that if the market doesn't like that, then we could see another blow up in yields like we did with trusts. Maybe not to the same extent, but it's going to put horrendous pressure on the UK.
Well, she's painted herself into a corner, effectively.
A
lot of what she's done. Okay, enough of the doom loop with the UK market. Again, that said, staying with politics then, saying that we're not a political podcast. Japan's ruling LDP expected to confirm early party election. Japan's, I'm not going to say it's in a mess because that's another hyperbole. But there are issues in Japan that need to be addressed, and this party, the LDP, are trying to get their head around it, running a minority government as they are at the moment. Do you got any views on the yen, particularly, or Japan, and what's going on there?
Yeah, they for Japan, they're in a bit of a mess. I mean, the ruling LDP party has sort of been bleeding support for quite a long time now. Ishiba, surprisingly, is continued to cling on, and we had news today from, I think it was Yomiuri, saying that rather than go to a leadership election, he'd rather dissolve Parliament and throw everything into a general election, because that would mean he would be in place for a general election, meaning he would cling on if he won that election. So there's a bit of politics going on in Japan regarding that. For the yen, I think it's still more concerned with what the Bank of Japan are doing. We had that wages data overnight with real wages going positive, I think, for the first time since last December, which is a big positive for the Bank of Japan. So slowly the stars are aligning for the BOJ to maybe drop a hike, maybe before the end of the year, or if not early into next year.
Do you think October is still a favourite period? I mean, a lot before. Well, last month we were looking at October time I think people are predicting October. Do you still think it's still the main case, or do you think they're known procrastinators? They're known to delay the inevitable. So
Yeah. That is exactly that. When you talk about monetary policy, Japanese style, you may think you get hints from the Fed about next month. Well, you get hints from them about the next 6 months. I can't put my finger on a date. Inflation's holding up well. I think with these real wages, if they see another month or 2 months of that continued rise in real wages, as I say, that'll be a big green tick in towards a hike. And who knows? They're not averse to putting a surprise hike out. They've done it before, and they may do it again. But certainly the next couple of meetings and early into 2026 could be the moment if they don't have that 1 step forward, 2 steps back situation that they seem to have an awful lot of.
Right. So I want to move on to the week ahead now, and again, on Sunday, we got OPEC Plus contemplated production hike, according to sources. Story from, I think, Reuters that was out yesterday. That's this Sunday for anyone wanting to keep an eye out for that. Again, I think the consensus was they'll keep production levels as is, but these stories do leak. And I think 8 members of OPEC Plus are set to meet on Sunday. So we should get some news out of that. We've got to get the Fed media blackout as of tomorrow ahead of their mid-month interest rate decision. We've touched a lot on monetary policy and what's happening, so we're not going to go into too much detail on that. But for this Fed meeting, then obviously we're stuck for a 25 basis point move, and as we've discussed, potential for there's very much an outlier that we could go bigger, but again, more likely we're re-entering a rate cutting cycle from the Fed, especially with the narrative that we've had around Trump and his new appointments that are set to come in. I think Mirren is the first of those, and we heard of Mirren's testimony this week, didn't we? Which was very much pro-Trump and dovish in what Mirren was saying. Anything from Mirren's commentary did you pay any attention to it, and anything that you saw in there that rings any bells?
I thought he was a bit more balanced than I was expecting. I think he remarked that he hadn't even been asked by anyone in the Trump administration to cut rates, which would have been a prerequisite for going for the job. I think it was a bit more balanced than maybe some expected, rather than really going dovish in his comments. It's going to be interesting. I would assume he's going to be in place for the September meeting, but I don't know how the cogs turn over there in the US after the hearing.
I think it's touch and go, because I do think to get him on board it would take everything to be aligned, but I don't think it's not the impossible. That he comes on.
I think that's an element that could shake things up, and people who are trading the Fed or looking to trade the Fed as to whether he's there or not. By the September FOMC. So that's another bit of uncertainty. We've got to wait to flow under the bridge and be decided. But I don't think he was as dovish or as he could have been.
No, but I mean, you've got to think that any new nominees of Fed officials coming in now have to be aligned with the president's way of thinking, or else they're not going to get in anyway. Or they're not going to be selected or nominated rather for the position. There was a story I read that he could potentially change all of the Fed board in over the coming couple of years to get his way, and it brings that question mark about the independence of the central bank, which is sacrosanct, is the word I'm looking for, really, isn't it? I mean, you don't need any questioning of the Fed's independence. Not at this time, especially with everything we've just said about paying the piper and everything else. You don't need the markets to start looking side-eyed at the Fed and just going, what's the motive behind that?
Yeah, exactly. And it is a problem. We've seen the market trading that issue with all the power stuff that went on and still going on now. We've got it with Lisa Cook. And again, it's just another bit of uncertainty that's in the pipe. If he uses his powers and fires Cooks. Well, he's tried to fire Cook, hasn't he? Sending her a letter, but she's staying on in her place. But if it goes to the courts and the court side with Trump, then it just changes the narrative for the whole of the Fed. It removes that independence and says, well, you're not independent because a president can just come in and hire and fire as he sees fit when he doesn't like things. And I think if that happens, that is going to be negative for the dollar. That's going to be negative for US as a whole, because it is, it's the second biggest central bank from the PBOC, but it's probably one of the most trusted. And you can't mess with that in any way, shape, or form, because once you've damaged that reputation, it's very hard to get it back.
Well, like you see with the PBOC, I mean, even if you mention them in the same breath, it's not great. It's not a great look anyway, is it? Really, on that front. If I'm questioning the independence of the PBOC, which I don't think even remotely tries to be or follow that narrative. We've got France PM extraordinary meeting and this everything that's going on in France at the moment. If you were looking at if you were trying to pick a worse situation than the UK yield situation, look at the French yield situation at the moment. We had some auctions out on Thursday, which sent the markets moving as well. Any views on the France situation and what could come of that? And does it worry you about your euro sterling position?
It's not so much of a concern for my position, but it is an issue. Obviously, France is one of many countries in the bloc, so while it could be big bad news, it doesn't affect the others, so to speak.
Second largest economy in the eurozone, though.
Yeah, it is. It's been doing badly for probably 2 years now. It's in a slump. Politics over there has been a mess since Macron failed in that election last year. So we haven't had a government there. We have, but not in real form. And he's doing the same as Ashiba. He's been trying to cling on. He's already said that just if the Prime Minister Bayrou doesn't pass this no confidence vote next week, he's not going to call an election, and he doesn't have to, I think, until July next year or sometime next year. And they're just going to stay in limbo politically. They won't be able to pass a budget, although we need to keep an eye at this weekend if there's some last minute deals cobbled together to get that budget passed, which is what this is mainly all about. But that won't be the end of it, even if they do, because, as I say, they haven't got a full government in place, respected government in place, and that won't continue, or that will continue until the next general election. So, is this going to be market moving on Monday if there's a no confidence vote that passes?
A lot of it's priced in, isn't it?
Yeah. I think so.
Sorry, just to tell the audience, he's expected to lose this confidence vote on Monday.
Yeah.
So that's almost been written in that he's set to lose unless something, like you say, something miraculous happens by Monday.
The real news was if it does trigger a quicker general election than when Macron would like to have one, which could mean the end of him. I mean, I call him the busybody because he's got his nose deep in all this Ukraine, Russia stuff. Whenever there's something going on, he's there front and centre. He's trying to keep himself busy. He's trying to keep himself, on the front pages, and this is how good he's doing and always involved. I think it's just politicking to keep himself relevant, so he doesn't get ousted. But that's more of personal opinion than anything market moving. But I don't think we're going to get much, as I say, unless it leads to an early election, which the market may take notice of.
Yeah, fair enough. We'll turn ourselves to the big event of next week, I guess, outside of the ECB decision, which is a non-event really, is the US CPI report. So you've got US inflation data out next, what was the date? I've got 11th of September. Really, that should set the markets up for the week, frame the market moves for the week, really. Because we are looking more at labour than in inflation, is this just a buy report? Do you just trade the short term? I mean, you're not a short term trader, but will you just ignore the noise, really, because we've got a Fed meeting the week after?
I don't think you can ignore it. a lot of Fed heads are now coming around to the idea that this inflationary blip isn't a blip; it's another transitory moment for inflation, and it's tariff-related and it's going to fade. But how far are they going to let that go? Is my question. If we get a couple more months and CPI is up around 3.5%, maybe near 4%, and the core is the same, how much longer can they allow that to keep going before reacting to it? So next week, I don't think anyone's going to game change over the numbers unless it's really super hot. At the very most, we know that Powell's shifted the focus, as have other Fed heads, as you mentioned, more to the jobs mandate. So I think for this report, if it's another warm one, if it's unchanged or it creeps up a bit, you're probably going to see a bit of a jump in yields, a bit of a rally in the dollar, a bit of a reversal for what we're seeing today. But I think that will get faded because the market is heavily invested in cuts for the Fed and how quick and how many more cuts there will be. So I think any upside in the dollar and yields will likely be faded on a hot number. Conversely, if we get softer inflation, if it starts coming down, maybe a two pip variation lower to what's expected, that's just going to be fuel to the fire for this dovish mood the market's in. And again, yields will head lower and so will the dollar.
Fair enough. Just a quick note from HSBC on next week's US inflation read. They expect headline CPI to rise 0.3% of the month, up from 0.2%, and this will result in a higher year-on-year inflation of 2.9%. Core inflation expected to rise at similar level of 0.3% on the month, led by higher vehicle prices. Lower rental inflation is likely to keep services inflation subdued for now. And on the PPI front, which is both numbers are inputted into what makes up the core PCE reading, which is what the Fed looks at when it does its calculations. They expect the PPI to rise 0.3% on the month and 3.3% year on year. So that's the CPI number. Interest rate decision, we've sort of touched upon this as well. ECB set to keep rates on hold, but is there a message in there really for subsequent decisions that come through? Do you think Lagarde will want to try and just map out in a Vegas way that she can about what we're likely to see from the ECB in the coming months?
Yeah, well, I believe it's another forecast meeting as well. Is that right? June? Yeah.
I think it is, yeah.
Yeah. So, there'll be a lot of focus around that. Do they see any further growth worries? Is their path for inflation going to change? Personally, I don't. There's no need for them to make any meaningful language changes or do any meaningful forward guidance. They've got inflation where they would like it. Any further rate cuts from here would start to move from restrictiveness to neutral to, sort of expansionary monetary policy, which they may need to go into if the economy doesn't pick up. The message from Lagarde recently is that they expect the economy to pick up a little bit. They're not expecting any gangbusters numbers, but they do expect the economy to continue not to collapse, shall we say. So yeah, I don't think there's any reason for them to change the message or her to change the message in this meeting. And as usual, it will kick the can and buy themselves some time till the next meeting.
Well, you've heard
themselves some time till the next meeting.
Well, you've heard comments from Schnabel, ECB executive board member. She was at a Reuters interview, I think, a couple of days ago, and says on economic resilience, Schnabel highlighted that the euro area has performed robustly, supported by strong domestic demand and easier financing conditions. Growth is broadly in line with potential levels. So again, I wouldn't expect Schnabel really of all the members to come out and say, "Oh my God, things are bad" or anything like that. But so I think, like you say, is keep the ship steady for the time being. And finally, then we want to look to UK GDP for July, the monthly read, which is out on Friday, next Friday. I've got a piece here that suggests that growth expected to flatline in the first of the monthly prints for Q3. And I think this is from Citi, a Citi forecast that says we see little movement in either the manufacturing or services, although this will likely return to growth in August. Any views on the UK? And we've looked at the wider picture and the fiscal picture. Any views on GDP or on its potential impact?
Yeah, it's got the potential to see a little bit of positivity, despite me having a sour mood over the UK in general. We have had a pretty good consumer-led summer. These numbers are for July, so there's the prospect of seeing some better data coming in. We've seen it from the PMIs recently as well. So that there are some reasons to be positive. So on the economic front, yes, I can see us maybe, posting some half decent numbers. Again, I'm not expecting jelly and ice cream and 5% GDP or anything like that. But yeah, we could. It's actually strange because this goes counter to my trading position. I can see the pound staying a bit supported, euro sterling maybe sort of staying in a range between 86 and 87. While we get some of this data that we have been, the issue is what happens when we get to that budget fiscal moment.
Sure.
Is that going to undo everything? So yeah, I see room for some positive data. How long that lasts is anyone's guess, and what happens after the budget is a further guess. So yeah, short term, we probably see some good things coming out.
Okay, nice to know. I've got a Deutsche Bank note on this. They say after a thumping beat in June, we expect a little bit of course correction to start the summer. Our nowcast model point to a small contraction in July of minus 0.1% on the month, with GDP dragged lower by services, manufacturing and construction. There's some upside risk to our call, however. The Women's Euro final could spur some upside in recreation activity, for instance. Our nowcast distribution also points to an upward skew in manufacturing output. Yeah, like you say, the weather's played a part for UK activity and should continue on the retail sales front, at least you'd like to think. Maybe, knowing this country, it's been a bit too hot for people to go outside and do any shopping. So there's always something down the line. And so you never know. But again, we've got the whole summer of activity to get on. And also, just a note on the UK Stats Office in terms of where this will be released as well. We should start seeing the reintroduction of PPI data, I think, in the next couple of months. That should help us garner some opinion. And that retail sales that was delayed as well. Both sides of the pond, you've got people questioning the reliability of state data. So it's going to be an interesting one to see if there's any revisions to anything and so forth. Anyway, that's for another episode. Ryan, listen, thank you very much for your input in today's episode. It's always appreciated.
Thank you very much, mate. Always a pleasure to be here.
Awesome. Listen, have a lovely weekend, and we'll push this out for anyone who'd like this to go out Friday evening, and listen back on your leisure. You can get it on all the major podcast platforms, and we'll post it on X and on the likes of LinkedIn and YouTube as well. But thank you all for listening. Ryan, thank you again, and have a nice weekend, everyone.
You too, mate. Thank you very much.
Cheers.
Thanks for tuning into the Live Sport podcast. Your edge in the market starts here. Subscribe now.